Hang on to your hat, folks. We are 4 weeks into the new year and already we are seeing commodity prices diverge. Gold is trapped as the market machine begs for rate cuts. Nickel dives so hard it knocks out Twiggy. The uranium bull continues to charge ahead. And what's on your Barbie this long weekend? I'm Shay Russell and welcome to Cocktails and Commodities, the resource podcast where macro analysis meets mining insights. Tap the like button so you get to hear more of my bogan accent in your speakers, but please remember, all information in this podcast is general in nature and not financial advice. As usual, markets are moving, there's lots to say, so let's start with my favourite commodity of all, gold. The money of kings sits at $2,015 per ounce, but don't be surprised if the gold price dips into the 1900s, and also don't rule out a rise back up to the 2050 level. The short version is gold's volatility from last year has been brought into this year. The Israel-Gaza war and to a lesser extent the near 2-year-old Ukraine-Russian war are providing ongoing support for gold. However, much of gold's day-to-day moves lie with what appear to be the hair-trigger trading fingers from Wall Street surrounding possible Federal Reserve Bank interest rate cuts. Once again, there is a disconnect between what the market machine wants and what the Fed will do. Back in December, the gold price surged on the end of the final Fed meeting for the year as many interpreted the Fed to now have an easing bias. While minutes from this meeting aren't due until next week, this is a delusional interpretation of events. Reality is now starting to sink in, and cuts from the Fed at the March meeting are becoming increasingly unlikely. Fed Governor Christopher Wallen recently said the last leg of inflation is proving particularly stubborn and rates shouldn't be cut until lower inflation can be sustained, saying, with economic activity and labour markets in good shape and inflation coming down gradually to 2%, I see no reason to move as quickly or cut as rapidly in the past. Sure, individual pieces of the US economy are problematic. Consumer sentiment in the US is at 2009 recession levels, and there are serious housing affordability issues across the country. But the sum of all parts, such as manufacturing, labour participation, GDP, and the Consumer Price Index, are all showing positive signs that make immediate rate cuts unlikely. Gold rallied in December 2023, pretty much turning a deaf ear to any pushback on rate cuts from Fed officials at the time. A robust US economy doesn't get a rate cut, and this could bring gold down in the coming weeks. Copper is where we left it last year, around $380 per pound. Silver is struggling to crack above $23 an ounce, and iron ore is back at $130 per ton as steel mills in China tend to increase stockpiles ahead of the Lunar New Year holiday period. The metal causing the most ruckus in Australia this week is nickel. Nickel spent all of 2023 in a downward spiral, dropping 43% over the year, and Citigroup analysts reckon it will fall to a low of $15,500 per ton in the coming months before this metal finds a bottom. With nickel currently trading around $16,400 per ton, this near halving of prices is causing widespread disruption across the Australian nickel sector. Andrew Forrest, the former CEO of Fortescue Metals, though better known in Australia as Andrew Twiggy, has closed one of his nickel mines. The Cassie mine, owned by Twiggy's privately held Wyloo Metals, will be placed into care and maintenance on May 31. A direct consequence of this will be that BHP is now shutting down part of their Kambalda nickel processing plant 2 weeks after the Cassie mine closes. Twiggy's Cassie mine is a major source of ore for the Kambalda concentrators plant. These two Australian giants of industry aren't alone either. Canadian miner Quantum Minerals said earlier in the month that it would shut down its Ravensthorpe nickel mine and now process stockpiles instead. Panoramic Resources has entered administration and is shutting down the Savannah nickel mine, and IGO has halted construction of their Cosmos nickel operation in Western Australia. With nickel prices at their lowest in 3 years, Australia's $5 billion nickel industry is looking pretty crook. The nickel price wipeout and growing global glut of supply is leaving super cheap nickel refiners to dominate the market. This is raising concerns that Australia is out of the battery metals processing race before it even started. Indonesia produces 40% of the world's nickel, largely off the back of cheap labour and energy, and so far seems resistant to price falls. With numerous Australian nickel mine closures and now several hundred people out of work, thought bubbles have emerged from various branches of Australian government looking to support the industry by creating a green premium. That is, create some sort of tiered pricing structure to distinguish nickel that was produced under high environmental and social standards, such as those within Australia, as opposed to, as one industry insider puts it, highly pollutive nickel, which is squeezing out clean nickel from Australian producers. Calling Australian nickel clean is a stretch. Let's not put lipstick on a pig. While Australian nickel is produced under much higher environmental and ethical standards, nickel production still involves an enormous amount of energy, chemicals, and water. Setting a premium for ethically mined metals is all good in theory, but the green premium is something that is mostly valuable at a consumer level, where the sum of all parts can be verified as ethical. Given most nickel buyers are original equipment manufacturers, the green premium may be a tougher sell to the OEMs. The argument being put forward by miners is that they aren't on a level playing field when it comes to the downstream processing of minerals. Major competitors, such as Indonesia in this case, are running much cheaper operations thanks to labour and energy cost being significantly lower than Australia. But these industries, in particular the nickel industry, is also highly subsidised by local, state and federal governments to keep the operations running when prices are low. Australian Resources Minister Madeleine King has said she will accelerate talks with Treasury about creating a tax break for metal processors affected, but has given little details on how or what that would look like. Subsidising Australia's metal processing sector is something we've discussed frequently here on Cocktails and Commodities. If you haven't already, I urge you to go watch my interview with Clyde Russell, which aired on the 1st of December 2023. This was an excellent interview where Clyde explained how China not only dominates the processing of every metal available, but how vulnerable the West is to China crashing the price of battery metals and rare earths, as well as how heavily subsidised their downstream sector is. What's happening with nickel right now is going to become a much bigger theme in the coming years, and that is just how much financial support and tax breaks will the Australian government be willing to provide in order to wrestle downstream processing away from China? And what would a news update be without talking about uranium? Uranium appears to be unstoppable at the moment, with the spot price breaching over $100 per pound last week, bringing uranium to its highest price since October 2007. Yep, for rusted on uranium bulls, it's been almost 17 years since we were last here. Now, having cut my analyst teeth during the noughties uranium bull market, my enthusiasm for the uranium rally is a little more muted. Mostly because at my weary age, I know a straight line up is often followed by a straight line down. However, word on the investment street is that I shouldn't be a downer about it because this time it's different. The uranium spot price soared from $80 in December to today's $106 on the back of news that Kazatomprom and Cameco, the world's two largest uranium producers, are struggling to increase supply, with Kazatomprom warning they won't be able to meet previous production guidance for 2024. As noted in several of last year's podcasts with guests like Rick Rule and Terry Uranium, there isn't a lot of spare uranium floating around at present. As noted in several of last year's podcasts and with guests like Rick Rule and Terry Uranium, there isn't a lot of spare uranium floating around at the moment. And investment bank Liberum says the uranium deficit will persist this year, again, forecasting a £300,000 uranium deficit for 2024. Also underpinning uranium's recent leg up is the global reality check that renewable energy won't get us near decarbonisation targets alone. During the 2023 United Nations Climate Change Conference held in Dubai this year and referred to as COP28, 22 nuclear states pledged to triple their nuclear capacity by 2050. China alone will be adding 150 nuclear reactors in the next 15 years. Closer to home, Shaw and Partners have suggested the uranium spot price could reach $150 per pound in the next 12 months. In less than 2 months, the uranium spot price is up 32%, but uranium stocks, measured today by the Beta Shares Global Uranium ETF, is only up 22% in the same period. Because of the fundamentals, Shaw and Partners reckon uranium stocks have further to run, so maybe it really is different this time. Australia is a land of unique traditions. We've got the Bunnings sausage sizzle, the obscure game of two-up. We shorten long words by whacking on O's, E's and A's, and we lengthen short words by dragging out those same vowels. Most of us have a well-deserved fear of walking past magpies, and we collectively look forward to the post-Christmas, pre-Australia Day lamb ad. Created in 2004 by the Meat and Livestock Association, the We Love Our Lamb campaign was designed to get us to eat more red meat. And based on the New Year stockyard sales of sheep, it might be time to stock up on your favourite cut of lamb. Just last year, farmers were practically giving away sheep for free as lamb and mutton prices dived. Why? Let's step back a few years. The crippling 3-year drought, which started in 2016, saw farmers heavily reduce their flock as they couldn't afford to look after them anymore. As one Dubbo livestock agent put it, come 2020 and the following 3 years of good rainfall, farmers went hammer and tong in rebuilding their flock. But by 2023, the hammer and tong approach backfired as farmers across the country caused Australia's sheep population to explode to 79 million. That's about 3 times more sheep than people in Australia and the highest number of sheep since 2007. As the sheep population flourished, prices crashed 75% in 2023 alone, reaching a 16-year low last year. Farmers went from getting $10 a kilo to $3 or $4 a kilo on a good day. The sheep price falls were happening at the same time every farm input was rising. We're talking fertiliser, fuel, interest rates, and trucking costs, just to name a few. Lamb and mutton prices were so dire that farmers could no longer justify the cost of transporting them to abattoirs, which were largely full anyway. Of course, the 2023 price falls were good for the consumer, but it sucked for farmers as their sheep flocks didn't even break even. But the January 2024 stock sales suggest that maybe the bottom is in for lamb prices. Already sales in Ballarat and Wagga Wagga have seen prices rise, and in some cases sheep have been fetching $30 to $50 per head this month. Overall number of sheep for sale was down for the month, but the processors, that is the supermarkets, bought up as much as they could, and there were hardly any back-to-paddock sheep this month. So I suggest you should buy your favourite cut of lamb and enjoy it this long weekend, because if the January stockyard sales are anything to go by, the days of cheap lamb for the barbie might be over. Have you bought into the market narrative, and do you think rate cuts from the Fed are near? Do you support the Australian government tax breaks for nickel processors, or do you reckon the downstream processing should be left to the free market? Tell me what you think. Leave a comment on Spotify, YouTube, LinkedIn, or find me on Twitter at Shay A. Russell. I'm always around for a chat and I love to talk about commodities. And of course, if you aren't already, tap the follow button so you always know what stocks are making news, which commodities are moving markets, and the companies trying to get it out of the ground. That's the tip.